ServiceNow just reported earnings, and the market reaction was brutal, down 20%. But what's inside this report is what really moved the stock. Lately, the whole software sector has been under pressure, and ServiceNow is no exception. It's down more than 40% year to date. So the question is simple: what actually changed here? Let's go straight into the earnings report. ServiceNow's non-GAAP EPS came in at 97 cents, in line with expectations and up 19.6% year over year. Meanwhile, revenue grew 21.3% to $3.77 billion, just barely beating the $3.75 billion consensus. The company tends to beat EPS expectations noticeably, so this quarter's inline result stands out. ServiceNow raised full-year subscription revenue guidance to about $15.7 billion, implying 22% growth. Sounds strong, but most of that bump comes from the Armis acquisition, contributing 125 BPs, which nearly offsets the upgrade. Margins are taking a hit. Gross margin down to 81.5%, operating margin to 31.5%, and free cash flow margin to 35%, all pressured by the deal. CRPO also dipped sequentially, and while it's expected to rebound next quarter, growth is slowing slightly below the usual 20% plus pace. One of the more impressive parts of its earnings report was the one regarding its AI tool, Now Assist. Its customers spending over $1 million in annual contract value grew over 130% year over year. Still, despite solid fundamentals, the market isn't impressed yet. Stock-based compensation is hard to ignore here. Non-GAAP EPS rose from 81 cents to 97 cents, but GAAP EPS barely moved from 44 to 45 cents. Why? SBC jumped 16% year over year to $547 million. Free cash flow also looks less impressive on closer inspection, $1.67 billion reported, but closer to $1.53 billion using the standard definition, and under $1 billion if you exclude SBC. The company even repurchased 20 million shares just to offset dilution, which tells you SBC is a real cost. Management says they'll reduce it going forward, but investors will want proof, not promises. Renewal rates slipped from 98% to 97%. Still strong, but it breaks a long streak of 98 to 99%. This isn't just noise. Previous dips had one-off reasons, but this looks like a real downtick. The big question, is this the start of a trend, especially with AI concerns rising? In this market, even small cracks like this can shake investor confidence. Overall, ServiceNow delivered solid results, but solid isn't enough right now. Investors are looking for clear signs that AI is driving faster growth, and that hasn't shown up yet. Until it does, the stock may struggle to gain momentum. After going through the financial report, what we can see is a clear valuation compression. The stock is now trading at around a 52 PE. Over the past 5 years, the stock is actually down more than 20%, while the S&P 500 is up nearly 70%, showing a significant underperformance in that period. But that doesn't automatically mean the stock is cheap. It just means it's cheaper than it used to be. At the same time, if you zoom out to 10 years, ServiceNow still significantly outperforms the S&P 500 by more than 2x. If we look at forward valuation, the picture changes quite a bit. Forward PE is around 20, and the PEG ratio is roughly 0.8, which on paper looks very attractive. Despite all the concerns and weak performance year to date, this is still a company expected to grow revenue at around 20% CAGR over the next 2 years. EPS is expected to grow about 30% plus on a forward basis, with long-term EPS growth estimates still in the mid-20s. So on a forward basis, the stock starts to look much more attractive and, in some ways, even compelling. Margin-wise, ServiceNow still looks like a high-quality software company. Gross margin is around 76%, slightly down from about 79% in 2024, but still at very strong levels. The bigger gap shows up in operating margin. On a GAAP basis, operating margin is only around 13%. Even though it has been gradually improving over time. On a non-GAAP basis, it's closer to 30%, and the difference mainly comes from stock-based compensation. This is a key point because it creates a big gap between reported profitability and adjusted numbers. Net margin is also relatively low at around 12 to 13% for the same reason. However, free cash flow margin is very strong at around 34%. But a large part of that cash flow ultimately goes into share buybacks, which helps offset dilution from stock-based compensation. One of the key issues with this company is return on invested capital. In 2023, ROIC was around 13.9%, which is strong. But in 2024, it dropped to about 9.2%, and in 2025, it stayed roughly at 9.1%. So we are not seeing any real improvement here. In fact, it has compressed and stayed flat. More importantly, ROIC is now slightly below WACC, which is around 10%. That means the company is barely covering its cost of capital, and value creation for shareholders is very limited at current levels. Moving into the DCF valuation, I used 3 scenarios with WACC assumptions of 9%, 10%, and 11% for bull, base, and bear cases. The weighted target price from the DCF came out at around $70, which implies roughly 21% downside from current levels. So based on this model, the stock still looks overvalued, even after a 20% drop and despite being near 52-week lows. As I mentioned earlier, that doesn't make it cheap, it just makes it less expensive. This result is also consistent with what we see in the broader valuation multiples. On an EV to EBITDA basis, I used exit multiples of 20x in the base case, 23x in the bull case, and 17x in the bear case. Current EV to EBITDA is around 26x, so I even assumed some multiple compression. That gives a weighted target price of about $106, which translates into roughly a 3.5% compound annual return over 5 years. So there is no meaningful upside from current levels. Both approaches, DCF and multiples, are pointing to the same conclusion. The stock looks overvalued. When it comes to potential returns for ServiceNow, here's how I see it. Even after the recent multiple compression, I assume that over the next 5 years the PE will normalize below current levels around 50. So in my model, I use exit multiples of 25, 30, and 35. For EPS growth, I assume 21% in the bear case, 24% in the base case in line with expectations, and 27% in the bull case. That gives me about a 10.5% annual return in the base case, which is roughly in line with the market and not particularly attractive. In the bull case, returns can reach around 16 to 17%, while in the bear case they drop to around 4%. Now, to achieve my target return of at least 15% CAGR with a 10% margin of safety, my model implies an entry price of 66.8x. That's slightly below the intrinsic value I got from my DCF model. So for me, the stock only starts to look really interesting closer to the $70 level. If we assume an entry around $70, the return profile improves meaningfully. With growth in line with expectations and a 30x multiple, you're looking at roughly 16% annual returns. If the multiple stays higher, returns can go above 20%. And even in a weaker scenario, returns are still in the mid-single digits. So from $70, the setup starts to look quite attractive, which is not really the case at current prices. And of course, all of this is based on my assumptions. If your inputs are different, your results will be different as well. So, moving to the conclusion. Personally, I'm staying away from the stock for now. The trend is clearly negative, and the company hasn't been able to deliver anything strong enough to change that. We're seeing some pressure in key metrics like renewal rates, even though they're still relatively high. At the same time, there's no clear catalyst that could reverse the current stock trend. Growth is not accelerating. If anything, it's slowing compared to previous years. Stock-based compensation remains elevated, which continues to weigh on both operating and net margins. And importantly, ROIC is relatively low and not improving, which limits value creation. So even with solid long-term growth expectations, the overall setup doesn't look attractive enough for me. At this point, I'm not planning to buy the stock even around $70. It's not compelling enough for my strategy. Maybe at significantly lower levels, somewhere closer to $60, it becomes more interesting. But for now, I'm staying on the sidelines. That said, this is all based on my assumptions. If you believe the company can re-accelerate growth, improve ROIC, and fully capitalize on AI without disruption, then this could still be a strong long-term investment. But from where it stands today, I would rate ServiceNow as a hold. If you found this analysis useful, drop a like and subscribe. It really helps the channel. And let me know in the comments, do you see this as a buying opportunity, or is the market finally repricing the story?